Interesting.
Yeah. So let's go into the options probability, but maybe we can look at December, the first expiry or so after. I think December 17th, we're going to look at expiry on Probability Lab. If you're able to share your screen, it's kind of a test.
Yes.
And I'm going to maximize my screen so I can see it too.
So is that coming up? Can you see my screen now?
Yeah, I can see it.
Okay.
I can.
Yeah, and anyone listening on Twitter Spaces, Emmett said this earlier, but for anyone who joined later, if you want to follow along, seeing what we're showing on this probability lab through Interactive Brokers, hop over to the YouTube stream because you'll be able to see it there.
Yeah, and it'll be recorded as well, so people can watch it after the fact. The thing about the probability lab, most of Interactive Brokers is the user experience is not ideal a lot of times, and so the probability lab is an incredible tool in information wise, but like this, the fonts are tiny. I mean, there's no way for me to maximize the font to see the key thing we look at.
Yeah, let me get my glasses on actually.
Yeah. The key thing we look at here that most people can't see is the numbers in red at the bottom, which shows the probability percentages at different strike prices for December 17th, because you pulled up December 17th as a calendar date. You can see the big curve there. And so December 17th is like the first, I guess you go to December 10th, like the day after. But we like to just, if we're going to do something in options, we'll go to like December, there's December 10th there. But maybe let's go to December 17th, because if we were going to do something with options related, we'd like to do it December 17th, just because it gives an extra few days for the stock to kind of play out whatever news may or may not happen on December 9th. And so,
yeah, because I think the split last time around, it popped right away, but it continued to rally thereafter. So a lot of times, it's better to play a longer duration option. But
yeah. So if you look at like, where's the 50% mark in the red font at the bottom?
It's
like
strike
price?
Somewhere around 1,085, it looks like. Maybe it's like 1,090 somewhere in there. It's hard to tell exactly, but it looks like it's kind of right around here.
So it's about where the stock is trading right now. The stock is at 1,094. So the market's saying like 50-50, whether it's going to be above 1,085 or below 1,085 come December 17th. And so like the way Matt and I use the probability lab for informing what options bets we may or may not take is we might say, okay, before we even look at this, sort of like what we talked about with Chris Liss on betting odds, on our interview that was released over the weekend, like before we look at the NFL team matchups for the weekend and what the Vegas odd makers, this is like the Vegas odd makers version of sports betting. So this is, this is what the options market prices currently are pricing as probabilities mathematically. And so we might look at it and be like, okay, we think there's 25% chance that Tesla is going to hit $1,500 on a split, news within a few days of the split announcement. So if we think there's a 25% chance, we go to here and say, okay, what's $1,500 saying as a percentage chance there? What does it say, Matt? Can you read it out loud? It's hard to see.
It's about 97%.
Wow. So Tesla.
So there's like a 3% chance, roughly, according to the market, that Tesla will be at 1,500 or higher on December 17th.
Yeah. And the option pricing at that option is priced at 685 by 710. That's the bid offer. So $7 per contract is what it costs for a $1,500 call strike for December 17th. So if we thought legitimately there's a 25% chance that there was going to be a split and there was going to be a split and the Tesla was going to rally, that's the thing that I'm not sure about. Like, I think maybe let's say there is a 25% chance of a split in our minds. I'm not sure that automatically coincides with Tesla rallying 25% right in the days following like it did last time. History doesn't repeat itself always. It rhymes sometimes, but it doesn't repeat itself always. So I'm not, I would say, maybe it's like somewhere between a 3 and 10% chance or something like that. I don't know. So it's sort of in our mind's eye, like, hey, it seems to be, priced decently, or not priced well. And if you want to try to take advantage of it in our mind, but we're already so heavily invested in Tesla and we're biased towards Tesla. Always, we know we are, but it seems like, the interesting analysis to do December 17th, according to this probability options, probably. What about like the 1,250 strike? What does that show about for probability wise here? Let's see.
So it's like around 80%, probably 79% or something like that.
Okay. So the options are pricing in about an 80% chance that Tesla is going to be below 1,250, or only 20% chance that Tesla will go above 1,250 come December 17th. That's another thing to look at potentially. So you can look at this in various ways, but 3% chance of it being above $1,500 in like 2 or 3 weeks, if there's a major news announcement December 9th, you can kind of figure out, do you think that's right or not? So is the options market pricing in a major news announcement December 9th or not? It doesn't seem like it quite is to me. I don't know. What do you think, Matt?
Yeah, I don't think so either. But you got to kind of look at the payout. So like the 1,500, for example. What did you say that was priced at?
$7.
$7. So like you have to get, obviously, like at expiration you have to be at 1,507 or better. But
well, look at the
1,400.
It's like 1,500. If you buy the 1,400, that costs like $12. So you buy the 1,400 strike, $14. If it gets up to $1,500, that means you made like an 8x return on that.
Yeah. So that one to me seems a little bit more reasonable, because to make any money on the 1,500 strike, you basically have to get to like 1,600 in my mind to make up for the amount of risk that you've taken. Because I think there's probably a 90% plus probability that option, if you bought the 1,500, is going to end up worthless. Because even
these percentages we're throwing out, this is just our own like gut feelings. We don't have any like spreadsheet. This is our gut feelings of watching the stock for so many years closely.
Yeah. So like to me that that risk reward is not super apparent. But on the 1,400 strike, then it seems like there's at least more of a there's certainly a higher probability that you could have like a bagger kind of return. Because if it does get to 1,500, like again, maybe it's only a 5% chance. So then you've got a 5% chance that those options that you bought are worth $100 per contract, essentially. So I guess that's only a $5. In that case, that's an expected value of 5, which is slightly lower than the value there. But could also rally to 1,600. So you'd have to do like what's your percentage probability that it gets to each of the potential kind of like above the strike strike prices.
And these are weird trades because that most likely they're going to expire worthless and be losing trades. Like 5 out of 6 times or higher, you're probably going to lose all your money on this type of trade. And we realize that when we do them. But the 1 out of 5 or 1 out of 10 times it hits, you make a big return potentially. So it's a weird type of mindset to have on these types of trades. It's different. Yeah. But let's go into the February. Let's look at the February 2022 timeline here. So we're going to look at the February 22 and the January 2023. So a year out. So February 22 timeline. If we look at the same, look at the 1,500 strike for February 22. So this is after Q4's monster, we think it'll be a monster delivery number. Maybe it's incredible gross margins again, surprise. What's kind of what is it saying for the percentage for a 1,500 strike?
It's around 88% or so.
So the market is pricing, the options market is pricing only a 12% chance instead of like a 3% chance, like on the December 17th. It's pricing a 12% chance that Tesla will be above $1,500 come February 18th. And so that options right now, I'm looking at my option chains, is $40. So you can buy that option for about $40, $41 you could buy it for. That sounds expensive, right? But you have to think about the percentages here. I think it's a different way to look at it versus trying to price in your head. $41, that's expensive. But 12% chance is a much higher percentage than 3%, obviously. But $41, the stock would have to get to, for that to be a 10x return, 12%, goes into 108 times. So that'd be like an 8x return. Let's say it would have to be, you'd think the stock needs to get 8 times $41, 8 times $40, 320. So you need the stock to get to like 1820, as your kind of median expectation with a 12% chance almost, for that to be worth it. And to me that seems reasonable. It's not as it's just one way to think about it. You got to put these numbers together and think about it. Okay, is it do I think the stock's gonna get to $2,000 like unequivocally? Like, is that probable in my mind? Maybe some people are super bullish and think, oh, Tesla, as long as the macro market cooperates, I think Tesla's getting to 2,000 no problem by February after their earnings report. And if you think that's the case, maybe it's worth it to do this type of option trade, or maybe it's not, So there's just different ways to look at it, different probabilities. I hope this helps people. And let's go to January 2023. These are just all hypothetical scenarios. It's not stuff we're doing per se, but this is just hypothetical ways to look at using the options probability lab. So if you're looking at this January 2023 expiry, so it's like a year out options that are 1 year out. If you bought them now and you're in the US, you could sell them like before they expire for the capital gains treatment versus income treatment, that's advantageous. So that's why I like looking at these options that are like just over a year out, especially because if you do really well, you can get a much better tax treatment if you're in the US and you sell them just over a year long. So what's like, I don't know, 2000, what do you see for the 2000 for that one, Matt? For
about a 92% cumulative probability, so 8% chance it's above 2000.
Only 8%. Okay, so the market's pricing only an 8% chance. This option, because of the time value, is $112, I guess. Wow, $112 is the last price I'm seeing. And 8%, is that what you said, 8%?
Yep.
So that would have to go in 12. You'd have to get to like, to make it worth it, the stock has to get to like 3,000 plus. Like if you think that 8% is accurate, if that's what you think, but if you think it's a 50% chance it's above 2,000, then you could do the calculation yourself. $112. Oh, it just needs to go up to, $2,300 to make more than my 50% expected probability, So you have to kind of do the math yourself. The best thing to do is come up with the probability in your head first. If you've been watching Tesla carefully and you think you have an idea or sense of where you think the price could get to by a certain time, and you want to employ options, then for call options to try to see if you can magnify your return, the way we have occasionally, then you kind of set your own probabilities in mind. And then you look at this probability lab to see where the options are pricing it. And if your own probability is much more positive, in a significant way than what the probability lab is suggesting, then it may be worth it to buy some of those options, obviously. But you could be wrong more often than you're right. But when you're right, if you're right by a substantial amount, it can offset all the wrongs. And if you just keep getting it wrong time and time again, then it's probably not the type of investing or betting you should be doing. So I'm constantly evaluating my own ability to estimate the probabilities, and if I'm wrong a bunch of times in a row, I have to try to recalibrate my biases or expectations. And a lot of times the macro markets controlling, you have to also account into this the macro markets, because Tesla, whether you like it or not, it's kind of floating in the tide of the macro markets to a large degree. So as bullish as the market has been, if there's a bear market, all these call options are pretty much out the window. So you gotta think about okay, what are the chances of a macro market bear market in this time frame? So the longer out the options go, the higher the chance there's going to be some major crash or bear market correction going on that's going to drag everything down significantly, right? So you got to also weigh that in your mind when you're making these decisions. I don't know, Matt, you have anything else you want to add about this stuff, or?
Yeah, no, I mean, it's risky to use options. And so, I would never advise anybody to use them. But I think if you are inclined, just try to hold yourself accountable, like we've been talking about here. Assess your own kind of view of the probability. Kind of check your performance over time. I mean, if you're starting out, don't do it with a big percentage of your portfolio, and just kind of. When Emmett and I are using this as a tool for the portfolio that we manage, honestly, in looking through these couple examples that we looked at, nothing kind of jumps off the page of like, the market's got this way wrong. There's a huge discrepancy between what I think is going to happen and what the market is kind of pricing. So a lot of times the best thing you can do is just be patient and kind of wait for those opportunities. I mean, just for example, like if on say December 8th, if there's still kind of no movement in prices, and like the options prices by that time are a fraction of what they are right now, then it may be worthwhile to kind of take a flyer on it if the market's essentially pricing in like a minuscule probability that there's like $100 move in the stock in the next day or the next week. Yeah. So
when he says take a flyer, he means like put like 1% of your portfolio of your play money in it, right? Not like not even like 10% or 20%. Yeah, something tiny.
Right, willing to lose everything. But really, I think whether you're looking at a short term kind of like a flyer like that, where you're kind of playing something event driven, or in the past where I really have seen these forward curves look like drastically mispriced in the past. I mean, this is where Emmett's put idea kind of came from, right? Was, we've looked at calls, but looking at puts, you can come up with the same sort of scenario. And so I think that the right thing to do is to, look at the way that the market is pricing certain scenarios, and maybe try to play those. So like, for example, we've talked mostly about stuff that's kind of out of the money. But on the other side of the portfolio, or of the distribution here, the market's essentially saying there's a 25% chance that Tesla stock's going to be below $550 per share by January of 2023. So maybe with a very small portion of your capital, you could say, all right, maybe I want to sell some calls on that, or you could look at puts and
you sell some puts. You mean sell puts?
Yes.
Sell calls.
Sell
What you're
puts,
saying?
Yeah. Well, you buy calls, I guess. I mean, I should have said buy calls, because you can kind of like get some leverage. But I think you probably, if you're going to use this probability lab on that, you probably want to look at the puts, not the calls.
Yeah, I mean the calls for the 550 strike January 23, they're trading at like 600 or no, the last trade, that's the last trade from yesterday. So right now they're like 590. So yeah, you're not getting, I mean, you're getting a little leverage. You might as well just buy the stock on margin or something. But
it's very comparable to buying stock on margin. Yeah. So I mean, that's another way you can kind of, if you don't want to go on margin, but you do want a little bit more risk, that's one way you could kind of amplify your returns. But
the puts cost $47 for the January 2023 550. I mean, to me, that's like, in our mind, we think it's like a 2% chance it gets that low. I mean, they're really maybe at 5% or 10% if there's a big bear market in the stock market, then that's the 10% chance, but even if there is a big bear market in the stock market, we think Tesla would do so well that the stock would be above 550 billion market cap or whatever. It would be crazy for it to be below that.
To actually lose, you'd have to get closer to like 500, right? Because their price is $40. So
their price
at
47 was the last price,
or higher, or 503 or higher. Then
so it seems like selling those puts is a great deal. I mean, obviously, when you sell puts on something like that, then there's a certain amount of margin requirement that goes into holding those puts you're selling, and so you have to keep a certain amount of capital handy to cover that margin requirement of selling that naked put. But it seems like a great, I guess you can get a nice return if you do the math on the capital you commit to that. So that's sort of what we thought about when we sold the $1,000 puts for, in the beginning, earlier in this year. Good example, Matt.